It looks like we're heading into a period of unusual uncertainty in terms of the economic outlook. Reason for that is clear. After the US election, President Trump taking over, potential for the end of gridlock in American politics and more radical policy making. So our confidence that you'd be in this slow and steady economic environment, that's gone. The question is what replaces it. Could be positive. Deregulation and infrastructure investment might raise the potential growth rate of the US economy. It could be negative. Big tax cuts for the rich, constraints on immigration, and tariffs on imports. Important not just to believe in the good things. It may be good, it may be bad. So far, it's not at all clear. Our real concern is that the American economy doesn't have much excess capacity. You can already see rising wages and rising prices, so there's not really a lot of room for stimulus to growth at the moment. Probably means the Fed will be tightening interest rates quicker than previous planned. We're now looking at 8 rate hikes by the end of 2018 rather than 6. And you have to consider rising recession risk, maybe because of tariffs or because of some sort of boom and bust fiscal policy. I think it also casts a cloud over emerging markets. Sure, growth there is rebounding after a few tough years, but tariffs would be very bad, as would faster rate hikes from the Fed, especially the case in Asia. Of course, China is by far the biggest source of the US trade deficit. It must be at the forefront of the threat from tariffs. So clearly we have to consider a much wider range of possible outcomes than we did before, and we'll be looking at revising the situation in the first quarter of 2017 as the policy intentions of the new administration become clearer.
This month we keep urging caution where the market has already taken a positive view of the expected outcome under President-elect Trump. US equities have rallied as the market assumes that all the pro-growth policies will be enacted with a certain degree of speed, but ignoring some of the less market-friendly outcomes that may occur, or by discounting the equally likely outcome that not all the promises will make their way into actual policy. Furthermore, with the election out of the way, markets are now sure to focus on the next political issue, Europe. A constitutional referendum happens in Italy in early December. All the indications are that Mr. Renzi, the Prime Minister, will lose the election, and thereby his effort to fast-track some much-needed changes to keep Italy on track with its reform program. We don't see much upside, even if the election is a yes. There is still much to be done, and the actual market impact will be quite limited. Under a no scenario, there may be some disruptions that could be severe, so we continue to warrant some caution. Overall asset allocation remains on the cautious side. Fixed income is viewed as having more interest rate risk under the most of the Trump scenarios, so we advise to reduce duration in fixed income portfolios. After a slight scare in credit, we remain overweight the asset class in broad terms, but caution to bias exposures to the higher end of the credit spectrum. The year to date has seen some outsized gains for credit investors, and a slight trim before the end of the year is probably a prudent way to take some profits and to raise some cash in portfolios. With slightly higher cash weights in portfolios, investors will be able to take advantage of whatever opportunities arise from the greater degree of uncertainty faced by markets in the immediate future.